Hello, good day, good afternoon. This is the voice of Ken Akure, and this is the Master of Crypto class. At the end of all these training sessions, you should become a master of cryptocurrency. And in today's class, we'll be looking at crypto trading and investing strategies. Now, uh, before we go into the details, I would like us to understand that there's a big difference between trading and investing. And each of them might not be suitable for everybody. Not everybody can be a good trader. Not everybody might have the temperament to follow long-term investment strategies. But then everyone should be able to combine both in a little measure, or it is good that everyone has knowledge of both. Then you can now choose in what area you want to major in or focus 80% of your strength or of your capital. Now, trading is simply taking advantage of the short-term price fluctuations to make profits. Meaning in trading, you're looking at volatility. Volatility is like the up and down frequent movement of the price of an instrument, in this case of a crypto. Now in trading, you're looking at a few hours to a few weeks. When you're trading, you're looking at buying an asset, holding it for a few hours, then selling off. Uh, so you buy low when prices are low, then when prices go up, you sell. So that is trading, spot trading in crypto. Now, the time horizon or the time frame within which when you're doing that, you're a trader is within a few hours to weeks. But investing is long term. Investing doesn't really focus on the short term price changes, meaning investing doesn't care about volatility. It only cares about looking for an asset that you completely believe in, an asset that you know that this asset is not going to go away in the next few years, and that has a strong potential of going up in price. And you can only know that after doing thorough study and thorough research so that you can have that level of conviction. And that you need that level of conviction because at some point prices will go down. At some point prices will start going down. But if you are convinced that this asset is going to be around for a long time, then you will have the mental strength to keep holding on to it, even though prices may be going down in the short term. Now, in investing, you are looking at a time frame of from a month to years, maybe from 6 months to up to like 3 years or 4 years or 10 years or 20 years. Now, if you are holding an asset for that period, then you are investing. And like I said earlier, some people don't have that kind of money to lock up and leave it for 10 years. Why? Maybe because they are even still struggling to meet their basic needs. That's why I said that's why I said investing and trading might work differently for different people. But the goal is to always grow to that phase where your focus will be on investing. The truth is, trading uh, can be highly profitable, but then is highly stressful and is much, much riskier when you're trying to trade than when you're investing. Investing, you do a little bit of work, a lot of research, you buy the coin and hold it. Hold it for years, for many months, the price goes up, then you sell and make a profit. But in trading, if your capital is small, you can't really do investing. Why? Because you need your small capital to be generating steady profit for you, to meet your bills or do other things you want to do. So that's trading. Now, in crypto trading strategies, there are two strategies you can use in crypto trading. Now, we'll look at different investing strategies. We'll also look at different trading strategies. So for now, we are considering trading strategies. These are trading strategies. So in trading, there are many trading strategies, but there are two main strategies that you can use. The first one is a technical based strategy. The second one is a fundamental based strategy. And the technical based strategy means looking at the price, or the history rather, the history of the price of an instrument, then formulating a strategy that tells you the appropriate time to buy and the appropriate time to sell. Now, when you're doing that, you are following a technical based strategy, because now you're looking at the chart, the history of the chart, what price did a few weeks ago, a few months ago, and now you are formulating your strategy based on that. But the fundamentally based strategy, you are reading what they call fundamentals. Fundamental means it can be news events, it can be, news event, it can be happenings in the global economy, it can be news releases from the particular crypto asset or crypto coin that you're monitoring. It can even be upcoming events within on that asset that you're looking at. So if let's say a coin has news that they are going to be burning part of their coin, that is a fundamental news. Burning part of their coin means if they had, let's say, 10 million or let's say 100 million coins in circulation, and they decide that they want to burn uh, 200,000 of those coins every quarter. So every time it's happening, they want to burn 200,000 out of the 100 million. This is a coin burn, is a strong fundamental news. Why? Because they are reducing the circulating supply. And that will have an effect on the price. Why? Because if supply is reducing and demand is constant, then price will have to go up. So that's a fundamental news. So if you are now trading based on that information, then you are trading on a fundamentally based strategy. There are different fundamental events in crypto. There's halving, there's block halving. Do you understand? There is a hard fork. You will learn these terms as you go along. There's hard fork. There's hard fork. Which other one? There's coin burn. There's mainnet launch. There's mainnet launch. There's mainnet launch. It's called mainnet. There's block. There's hard fork. There's soft fork. There's which other one? Yeah, mainnet, coin burn. Yeah, so these are the key fundamental events within within the cryptocurrency ecosystems. Now, anytime a coin is having any of these events, there's always a reaction on the price. Another fundamental event might be news release, upgrade, release of new products. So anytime any of these activities are happening, it means that investors are watching for these news events and they are reacting accordingly. So this has a possibility of shooting up prices. So if you are not trading, if you are not deciding to buy a coin, let's say a coin like let's say a coin called Wu. Wu, for example, is migrating from the Ethereum network to their own main network. That shows that the developers are working and they are doing something. So that increase the valuation of that project at that moment. Why? Because people are anticipating that this is a good news. Let's buy. If they are having a mainland launch in 3 months' time from today, there are people who will start buying now in anticipation as the date gets nearer, and they are making announcements. More and more people will want to be part of that hype, and they will buy in, and that will push prices higher. So these people will buy based on this upcoming news, and when prices go up, they will sell. So that's one way of trading, which is fundamentally based. Now, we'll now look at crypto trading. We'll now look at investing strategies now. Investing strategies. Investing strategies. Now, we'll be looking at four today. These are the four main ones that a lot of people use. The first one is what is called dollar cost averaging. And dollar cost averaging, or DCA, is a strategy where an investor invests a total sum of money in small increments over time instead of all at once. The goal is to take advantage of market downturns without risking too much capital at any given time. Now, that is dollar cost averaging. Let me share a screen with you and explain what DCA is. Let me share the screen. Okay, so let's assume I go to, let me share another screen. So let's assume I go to, okay, no, sorry guys, let me share. Where are you? Okay, this is Google Chrome. So let's assume I go to TradingView. TradingView is a charting software where you analyze the price of an asset or the price of a cryptocurrency or if a forex pair or whatever. So let me hide all this. Okay, so let's say I want to do dollar cost averaging. Dollar cost averaging. So now I want to buy, this is Ethereum. This is a chart showing the price history or movement of this coin called Ethereum. Now, how do I do dollar cost averaging? Now, I just heard about Ethereum. I want to buy Ethereum with, I have $1,000 that I want to buy Ethereum with, but I don't know the best time and I don't want to use all my money to buy Ethereum all at once. Why? Because I'm afraid that what if I buy here and then the price starts going down? Remember, the purpose of trading or investing is so that you can buy low, you can buy when prices are low, you can buy when prices are low and sell when prices rise. So let's say you plan to buy at 1,800, then sell when prices get to 4,500. But now you don't know how fast price will move up. You don't even know when. But based on your fundamental research, you know that eventually price will move up, but you don't know when. And you only have $1,000 to do this investment. So what you do is when you're doing dollar cost averaging is that you split your $1,000, let's say into four parts. So that will be 250. If you split it into four, that will be let's say you have your $1,000, then you split it into four, divided by four, you now have 250. You now have $250 each per each part. So you now tell yourself that, okay, right now that I have this 1,000 that I want to invest, I'll use the first part, which is the first part, and I'll buy Ethereum. Maybe that was here. Ethereum was around $3,000. So your first $250, first $250, you buy at a price of $3,000. You bought Ethereum at $3,000. That's your first buy. Then you wait after a month to see what price will do. Let's say second month, second buy, which is a month after. When you're doing this, you'll be putting the date and all, the date that you bought. You spend the next $250, but this time around, price has dropped from 3,000 to, let's say, 2,000. Then you bought at the price of $2,000 per Ethereum. So this is Ethereum dollar cost averaging, first, second. Then let's say for the fourth one, for the third one, you decide to buy again, 250. Then let's say you are buying a month after. And after a month, price has dropped from 2,000. Let's say price dropped to this level, 1,480. So let's say you bought at a price of, let's abbreviate it, of 1,005, let's approximate rather, 1,500. Then you wait again. Instead of price going up, price is still going down. You're like, what will I do? So instead, but you stick to your plan. Your plan was that you're going to buy over a period of 4 months. That's when you spend your $250. So at the fourth one, you spend your last $250 that you've kept, and now price, instead of going down, price went up to, let's say price went up to, like, let's say 2,300. You don't care, you still buy. Why? Because you have said on so date, I'm going to buy. So irrespective of the price, you buy. Now, to get your average price, you now do an average of this, which is 3,000 plus 2,000, that's 5,000, plus 2,000, that's 7,000, uh 7,000, 8,005, 8,008. So you have 8,800 divided by, you now want to get an average, divided by 4, by 4 equals to, this should be 2 here, 2, 2, 2, 2, 2, 0, 0. Okay, 2, 2, 5, 0. I think thereabout. So your average price is $2,500. Now, what have you saved yourself? If you had bought everything at $3,000 and price is currently here, you'd have been in a loss already. But by buying at these different levels, you now have an average price which is lower than if you had bought everything at 3,000 when you first heard about it. So you now hold this till later. So this strategy stops you from panicking if prices are going against you. So that's the beauty of using dollar cost averaging. And sometimes this explanation I gave might be the opposite. When this happens to when prices are going up, but the best time to use dollar cost averaging is when prices are going down like they are now. If prices are going up, some people still do dollar cost averaging, but then it's usually not the best time. The strategy for dollar cost averaging is designed to be used during market downturns. Yes, during market downturn. By downturns, I mean it's designed to be used when prices are going down, not when prices are flying up. So that is a dollar cost averaging for you. So let me share again, go back to the slide. Okay, so that's dollar cost averaging. uh, and that's how it works. Now, the next one that the next investment strategy is what you call buy and hold, or buy and hold, or buy and hold, or buy and hold. HODL is an acronym that is used in crypto. It means hold on for dear life. You know this word, but it was actually coined by someone who wanted to spell hold, but then mistakenly spelled it as hodl, HODL, instead of HOLD. It now became popular within the crypto space. But in essence, what it means is that you just buy a coin and you hold it, irrespective of what price is doing. So instead of doing dollar cost averaging, where we just bought, where we wanted to invest $1,000 but spread it over a 4-time purchase, you could spread it over 10 times purchase or 20 times purchase, depending on you. But in buy and hold, you are spreading it over, you are not spreading it. That $1,000 investment that you had, you just come to the market, uh, you just come to the market, then use your entire $1,000 and buy the Ethereum all at once. Let's say at $3,000. You buy all the Ethereum with all your $1,000 at once. You now hold it. You now give your holding period. I'm going to hold this for 4 years. So you just buy it, you send it to your private wallet, maybe a cold storage or wherever, a wallet that you control, then leave it there for that 4 years that you said. And you have a target that, okay, I'm going to buy at 3,000, then I'll sell when price get to 10,000 or 20,000. So if price gets to 10,000, you'd have made 3 times your money, or 3.3 times your money. If it gets to 20,000, you'd have made about 6 point something x your money, meaning your $1,000 will have become $6,000. But you define the holding period and you don't care what prices do after that. Then a very popular one again is what you call buy every week or every month. This is also called intermittent buying. Intermittent buying is different from dollar cost averaging. Remember, the concept is similar, but then it's very different. Remember, in dollar cost averaging, you had marked the amount you wanted to spend, $1,000. But buy every month is slightly different. In buy every month, you might say, okay, my salary, for instance, is 200,000 naira. So at the end of every month, when I collect my salary, I'm going to use 10%, which is 20,000 naira, 10% of my salary, which is 20,000 naira, and I'll buy Bitcoin, the Bitcoin or Ethereum. I'll buy Ethereum with 20,000 naira. 20,000 naira is about $40. So I'm going to buy $40 worth of Ethereum from my monthly salary, and I'll do that for the next 3 years. So this is intermittent buying. Unlike the other guy, you don't have a big amount of money somewhere that you keep that you be buying from. You know, I say, okay, for my salary, instead of saving or starting a business or something, I'll be putting 10% into the coin that I have researched and is a good coin. So irrespective of the price, whether the price is going up or I don't care, whether it's coming down or I don't care, I just buy. I just buy. That is intermittent buying. Then those are the three main strategies of investing in crypto. Then there's a fourth strategy called initial coin offerings, or IDOs. So we'll go into that shortly. One will come back in the next session. When we come back in the next session, we'll go into that. For now, thank you guys for joining this class. See you in the next one.